Good afternoon, everybody, and welcome to Minds and Money session on metallurgical coal markets with a particular focus on Queensland. My name is Marian Hookham. I'm a director with IHS Markit. We are one of the world's preeminent providers of information data related to coal, oil, and a number of commodities. So it is my great pleasure today to host our panel of 4 experts. I've known all these men for many years, and they are a really excellent cross-section of representation of the sector. So we have a coal producer, which is Mark Bolton. Mark Bolton is the general manager of Jellinbah Group, a private independent company that's been around for 30-odd years. We have Matt Latimore, the founder and president of M Resources, an interesting company that started life as a trader, is now an investor, also is imminently going to move into coal production. We'll hear from Matt more about that, some of the challenges there. We also have Rajiv Mukherjee with Tata Steel, who is their General Procurement Manager, Vice President, Group Strategic Procurement is his full title. Excellent to have an end user represented here. Tata Steel, according to the World Steel Association, is the 12th largest steel producer in the world. So Rajiv's view will be really interesting in the context of our discussion today. And last but not least, we have Tom Sartor, who is an equities analyst with Morgans. Tom has been in the coal space and was once a mine engineer, but has excellent visibility on the funding, capital, equities environment that surrounds and challenges the met coal space today. So we look forward to hearing from you. So to set the scene for where we are right now, Australia is the world's biggest exporter and producer of metallurgical coal. We produce, sorry, I've just got my notes here, around 170 to 190 million tons of metallurgical coal. That covers all qualities, low vol, mid vol, hard coals, all the way through to PCIs and semi-softs. Queensland is the world's biggest exporter of metallurgical coal and accounts for roughly 87% of Australia's metallurgical coal exports. So we have an overweight influence on the world. China was, until November, one of the biggest buyers, close to India, of our metallurgical coal. Roughly in calendar 2019, we exported 42 million tons of metallurgical coal to China, again, of all categories, with a focus on prime low vol qualities of the type produced by BHP, Saraji Peak Downs quality. So in November 2020, something quite startling and extraordinary occurred, where China essentially shut the doors to the import of Australian coal. So we went from being roughly a 3 million ton per month China export destination to nothing. So the things that occurred instantly were FOB prices dropped around $10 to $15 for prime low vol, and the China CFR price climbed from, at that point in time, around 124 CFR to currently we assess it at 281 CFR, okay? So we'll come back to that in a moment. What I want to do now is I want to ask Mark Bolton to describe to us how, as a producer with exposure to China, what did you do? How did you handle this tectonic shift?
Well, thanks, Marian. Yes, I mean, it's an extraordinary period to sort of, for us, for Jellinbah Group, the best top of the market, 30% of our annual production went there, so over 3.5 million tons. We'd been in China since 2009, selling one of our coke and coals there, which for low ash, low sulfur, was right in their wheelhouse in terms of quality. Built up a great client base of both private and state-owned steel mills. And to have that I mean, you describe it as a I guess a crash stop, but you know, to be fair with the details there, it had been coming for quite some time. Now every year there'd been import restrictions were getting tightened up, and things were starting to already show from 2019 that quotas, and must remember China has quotas for all sorts of import materials, not just coals. But since 2019, they were starting to really clamp down on that. And of course, with COVID putting the brakes on the global economy in sort of early 2020, China really was the only steelmaking importing region that continued to power through that. So, of course, their import quotas were under pressure as the rest of the world, and Australia in particular, continued to produce coal and export there. So very quickly, around about June, I thought we arrived at where we thought in previous years we'd seen around October, November, where quotas were starting to get under pressure. And of course, on the back of that, we started to see the geopolitical challenges occurring and the friction, I guess, heating up between the two countries. And I'm not going to go into the politics of it, but clearly that was adding some additional pressure there. To a certain degree, we'd called it a little bit earlier. We're able to pivot tons already. Our last shipments were loaded in September, so it was already starting to really accelerate there. The vessel queues for discharge were growing, and our contacts on the ground had already telegraphed that something was coming down the line. And that was, of course, the complete closure of that market by November, December of 2020. Now, thankfully, at the same time, the other steel making regions of the world started to fire up again, and India, of course, was certainly, I guess, the next big clearinghouse. So while we had a fall off in demand there for Australian coal, don't forget, it was only Australian coal that was locked out. China, of course, is still powering along and heading towards another 1 billion tonne per annum hot metal year, record year, just like last year. It was Australian coal that was pushed out, but thankfully, trade flow disruptions enabled those more nimble producers, I guess, to be able to move in to those other markets and redistribute those China sales. Now, that rebalancing, depending on which statistics you look at, that process is still going on. But that massive overhang that really was there at the end of last year has pretty much been gobbled up by the strength in the rest of the global steel industry's, I guess, return post-COVID.
Thank you. That's a really excellent overview, Mark. I think I'd like to ask Matt, with your trading hat, Matt, to perhaps outline for us some of the opportunities that traders always somehow see an opportunity. Obviously, the US coal, as Mark was suggesting, really came quite strongly. I think it's up 109% year on year, US low vols into China. But other things occurred. Okay, do you perhaps want to run us through some of those trade flows, how they changed?
Sure. No, thanks, Marian. And Mark covered off the history there pretty well, but there were some signs that this was coming, with quotas, with trace elements. But the key point is that of that 40 million tonnes of Australian source coal that was going up to China, a large proportion of that was low vol premium coal, which had to find a home in other parts of the world. I think the initial tonnage that was displaced was filled by Mongolian coal. The stats kind of show that the Mongolian tonnage ramped up quite quickly, but the Mongolian tonnage faced its own issues and impacts from COVID as well. And that allowed the door to open for the US and other markets to increase their share into China. One of the headwinds for that is that a lot of the met coal contracts, as you know well, are annual with tonnage and then have pricing adjusted on a quarterly or on a spot or on an index basis, depending on whether it's on the bottom end of the curve or the top end of the quality curve. So that took some time for that reorganisation of trade to occur that Mark spoke of. And probably the end of March is a key date. With that, I think when you look at the stats now, that low to mid volatile coal out of Canada, the amount of tonnage that's going to China now is significantly greater than it was this time last year. And that's probably come out of sticky sort of markets and contractual markets, which has found room for the Australian coal to go into those other markets, which fortunately has coincided with extremely strong rebound in crude steel production and demand out of those non-Chinese markets, which has been quite extraordinary and has provided also a headwind for that coal. So from a trader's perspective, there's been reorganisation of trade, Marian, but it's taken a bit longer than thermal coal because of the nature of the product rather than the commodity nature that thermal coal is.
Matt, on the 183-ish price we're currently seeing for Australian FOB prices, you've both alluded to the underlying demand being driven by Japan, Korea, Taiwan, and obviously India for our met coal, and Brazil and Europe. Do you think the current rally is sustainable?
I mean,
why?
I think, Marian, I mean, we've seen a rally earlier in the year, which wasn't sustainable. I think the rally this time around is a lot more sustainable because of the structural issues that I just spoke about. For one, in terms of the earlier rally in price was driven by things like restocking, traders taking positions, and those type of things, whereas this rally is driven by fundamental shift in trade flows and a fundamental shift in the supply-demand balance and that reorganisation of trade. And I think very positively, we see now steel prices for hot rolled coil at up to $1,200 in regions outside of China, and even in China, $900. So the affordability is there. Steel prices have doubled in the period from the end of last year until now. And that provides a segue and room to sustain these higher prices also from an affordability perspective. Obviously, we have Mr. Mukerjee online and hear his comments on that. But for all those reasons, I think there's still headroom in the FOB number. And I think that it is much more sustainable.
Would definitely like to hear Rajiv's view, but linked to that question, Rajiv, I'd like to understand from an end user perspective. We've heard from the producer and the trader view. As a buyer, were there, I suspect there were, probably, I'm guessing, but did you get hold of some good quality, low vol Australian coal at dirt cheap prices, for example? What other opportunities were there in the disruption for you?
Yeah, thanks, Marian. Look, well, we all of us know that, throughout most of last year and good part of early this year, coal prices, low vol, prime, hard coking coal was really, as you term it, dirt cheap, right? But in our opinion, this is not a structural change, right? So obviously, as pointed out, the market equilibrium, the trade has changed. But you have to remember two things, So it's opportunistic. The US coal producers, where they stand on the cost curve, is far different from where the Australian producers stand, right? And so we've seen a change of trade flows from Australia out of China into Europe and more in India as well. And of course, mentioned in Taiwan, Japan, and Korea. But we also believe that if the equilibrium and the trade flows are restored to its original status quo, we will see US coal. That's a swing market. It obviously sits where it sits on the cost curve. It can't sustain these kind of volumes. Everybody can afford to export coal at 283 CNF China, but if it comes back to 130, 140. Then we're going to see some tonnage come out of the market. We're going to see, obviously we've already seen Australian prices go up. They're at 180 now because we are buying. We have European mills are buying from Australia now because we don't want to go to the US, right? Because at 280, nobody wants coal and they don't want to sell to us. It's the same with Far East Russian coal. That's most of them are looking at China, but for us, it's opportunistic. We got some, yes, we enjoyed the market when it was at its very lowest, but we think that, post-resolution, hopefully resolution of all these trade spats and disputes, the market will rebalance and coal prices will come back to where they were at prior to this entire dispute and trade war with China.
It's an interesting question, Rajiv, and the one that comes up all the time is how long this trade dispute continues. And I remember very clearly speaking with pretty much all of you about this initially. How long would this continue for? And people all over the world were saying, oh, a couple of months. China cannot produce 1 billion tons of steel without Australian prime low vols. Well, they've proven us wrong on that count. Now, who knows when the trade dispute will end? As Mark intimated, there's no sign of the political rhetoric dying down. And some people, from a mine perspective, mine sequencing perspective, are now considering maybe at the end of 2022. So we're looking at a long period of time. And to your point, Rajiv, there are US producers now that are contemplating a more strategic position in Asia and China. Okay, as you point out, the costs have to, the price they achieve has to sustain that higher cost. But there is a firming view that that trade flow is not just going to be temporary for now.
Yeah, yes, but you have to also consider that the steel industry is highly cyclical, right? Yeah. We are enjoying very high prices. It's not going to stay there, right? It is going to rebalance. And once that happens, I don't see, China, if you may, buying coal at $273 if HR prices come back to $500, $600, right? That's not sustainable, right? So I don't know about the entire trade dispute across the gamut of products and services, but certainly for coal, they will be looking for solutions. If we have a declining steel market and we can't have coal at 270, iron ore at 200, and talking about China, it's not sustainable. So it will rebalance.
The question is when, of course.
Yeah, the moment steel prices come down, I presume. And that, I suppose, maybe another year, 8 months, and then it will rebalance. That's my call, it's personal opinion.
I'd like to now ask Tom to talk about the other kind of really major issue that is on all of our minds, and that is really ESG. I'd like all of you at some point to talk about ESG, but Tom, set the stage for us. What are you seeing in terms of changing attitudes from equity markets around ESG, and particularly coal, and I guess particularly thermal, met coal compared with thermal?
Sure. Thanks, Marian. Good day, everyone. This idea of ESG influencing the sector has been around for quite some time, so it's not a new phenomenon, but it does continue to unfold and accelerate. I guess having worked with listed coal companies for a long time and seeing the level of interest from investors, we are seeing the ongoing requirement of investors on the managers of their money, placing higher limitations and restrictions on those managers around what exposure they can take to not only thermal coal, but fossil fuels in general. And I guess it really is all about carbon emissions. It started there, at least, in terms of its impact on coal, and that's widely understood. But what has happened in the last 12 months is that has accelerated quite sharply across into met coal, certainly, but not only there, but into oil and gas quite a lot, into coal infrastructure and into oil and gas infrastructure as well. I sit next to an infrastructure analyst who scratches his head about how Horizon, for example, can trade on a gross cashed up yield of over 10%. You've got Dalrymple Bay infrastructure on 9 and a bit %. So those trends are accelerating, and there's some really interesting things unfolding in the oil and gas side of that market. The similar effect is unfolding in the debt markets. That gets a lot of press. I'd comment that that's probably behind equity investors at the moment, but it is picking up some momentum. The really interesting one for me is alongside those carbon concerns, if you want to call it, that as the ESG issue, you've also got in met coal growing questions about the long-term sustainability of the industry. And that might sound dramatic, but this is what investors are, asking us. And I'd love to hear about what this panel thinks about green hydrogen and green steel. But for a stock like Horizon to trade at the price that it does, it infers that volumes in met coal in Queensland go into terminal decline, and there are reasons why. There are some very divergent views in this space where someone's going to be quite wrong, and there are going to be fortunes won and lost on positioning correctly for that. And so, in the mix, you've also got China policy and that changing direction. It is really quite dynamic, but yes, ESG is certainly accelerating across the board.
Turning to Mark on that point, Mark, obviously you're looking ahead to future developments, maybe some additional coal pits that you might bring online. I presume these would be brownfield rather than greenfield.
Yeah, Marian. Look, we're a private coal company, and ESG is important to us, but it has, I guess, a different weighting and a different set of drivers in our business. We do have long life assets. We still have 30, 40 years worth of reserves in the ground, and that's after 30 years of operation. So that's an interesting challenge in itself. But bringing those on, but you allude to potential future expansions or extensions, and yes, it's brownfield. And I mean, now, I guess the house view is that in the future, it is just getting harder to dig a hole anywhere, particularly greenfield business. Brownfields is potentially the future as far as being able to continue on getting your license to operate extended. I mean, for us, we've always run a policy here of trying to bring each of our leases up through to the highest level, which is the mining lease. And even though today a mining lease, is not really a right to mine. It is something you must continue to work on and work with your stakeholders around that. And so when you do get approvals through, and this is an interesting one, I guess, for Tom, is that you're bringing, you're actually, you need to move on those probably faster than you used to do, even 5 years ago. You must move on that. Of course, that drags capital forward. The sunk capital, particularly if it's something 10 or 15 years down the track. So it actually adds another cost layer into the business, or a sinking capital into areas which 10 or 15 years ago ordinarily you wouldn't do. I mean, I even a case of when you do have approvals, and you might have had them for 20 years, the lens of today may be different to that. And I guess Rio Tinto saw that with Juukan Gorge. Even though the approvals were there, the actual lens of which you look at those things are different. So yeah, that's essentially a bit of a summary for ourselves. We push on, but brownfield, as far as we can see in Queensland, and I guess Matt can add a bit more on this, brownfield expansion is where we see the future supply of metallurgical coal.
Very much so. And to Matt now, you are that rarest of beasts where you're about to bring a mine into production. Now, admittedly, it was pre-loved, and you acquired from Peabody. So roughly 1.4 million tonnes a year you're chasing from the Millennium Mavis Downs operation. And I believe by next month, you hope to be in production. It's quite a rare feat in this market.
Yeah, thanks, Marian. And I think Mark touched on it, that our view is that the value of a mining lease in Queensland in some ways is going up materially. We charged on pretty strongly through COVID and through the Chinese trade situation, knowing that both would resolve themselves through the reallocation of trade we spoke about, and eventually stimulus and economic growth recovery. and it's a low capex, low cost approach with an existing mining lease to get and extract the total maximum economic value you can out of the existing, reserves or permanent reserves. We're trying to build a portfolio of low cost met coal investments and mines because we believe in the fundamentals of the demand, particularly over the short to medium term. Maybe people are going to be a little more reticent to pay very big numbers up front for assets, but this type of approach where you've got a small capital outlay up front to extract the economic values. I was looking this morning at a May independent forecast for the demand of met coal, which is up 70 million tonnes from a leading global authority between 21 and 25. And that demand is going to come from Southeast Asia, India, North Asia, Middle East, Indonesia, for example. Where is the coal going to come from to feed those markets when you have the major suppliers are generally big publicly listed companies who are reticent to put capital investment into mines? Some of them are in divestment processes. And, you've seen the regulatory issues, the Grassy Mountain announcement last week in Canada. There's all these headwinds to supply, but demand is going to keep growing very strongly until a technological advancement comes along that can actually produce in decent volumes, green steel. We're very interested in those developments and what's happening in Sweden and with Boston Metals and even NCE in Japan. And there's a lot of interest in hydrogen, and I think our customers globally are very good corporate citizens, and they'll take what their government tells them and the directions and the leads very seriously. And there will be a lot of support from governments in the major supply areas like Australia as well to sort of get into that space. But I think that there's going to be a gap which is going to provide a very healthy return over the midterm.
Segueing with that thematic to Rajiv, I understand that Tata has a number of projects, Rajiv, looking at ultimately replacing coal, coke, looking at green hydrogen. Could you run us through, I guess, how long, in your view, does coal have left, coking coal?
Yeah, well, thanks. Let me start by saying that we're just about to commission another 5 million tons blast furnace capacity next year, that take our India production up to 25 million tons. So it's not going anywhere soon, going away anywhere soon. So, but having said that, I think, as was mentioned, governments not only are supporting, they're also pressuring industry to, look at alternatives to carbon fuel. So there is the first stage would be, of course, to reduce consumption. And how do you do it in your existing facilities? And there, you could do oxygen enrichment, you can reduce PCI, you could do a variety of other hardware modifications to improve your coke rates, etc. So that would be, I think, the first kind of initiative. But going beyond that, hydrogen certainly is an expensive reductant at the moment. The process of making it either by electrolysis or producing it by electrolysis, or we're looking at a relatively new technology called syngas, which is basically the gasification of biomass, and the end product is hydrogen. The other issue is, how do you then inject that hydrogen into a blast furnace? It has to have a carrier, so you have to have a hydrogen-bearing gas. So the cost of that, how do you put it in, how it will enter the blast furnace is something a matter of discussion. So that's one set. The other set is electric arc steel making, which is through scrap. Now, different economies are differently positioned, right? So say like India is not as well positioned as a scrap producer or because of the stage at which the economy is as compared to US or Europe. So whilst you can use scrap for electric arc steel making, and that's what we have done as a producer, we've also set up a scrap processing unit, and we're looking at enlarging that business because we believe that electric arc furnace will take hold in a big way in India. The other issue is where we can use gas-based DRI. I mean, we have coal-based DRI, but that's not the solution. It is polluting. But the issue with gas-based DRI is where to get the gas from, and if you need natural gas, and if you're not close to natural gas, it's very expensive to transport it. But yeah, in India we have seen some opportunities opening up for natural gas. So that would be the other option that we'd look at. And then, of course, we're working on a technology called HYSANA, which was patented in Europe, and as you may be aware. And that looks at lower use of coal, especially non-coking coal, because there's no agglomeration either of iron or coal. And then if you use that with carbon capture, then there's a possibility of almost 80% reduction in carbon emissions. So these are the various themes we're working on, but I will not say that they're just around the corner. They will take some time, and I think there will be certainly a robust demand for coking coal in the next few years.
And certainly, I think the point you made to me earlier was economies of scale. Some of these things might work at maybe a million tons or something, but as soon as you want to start competing with blast furnace capacity, they cannot at the moment.
Yeah, well, DRI, etc. You could get there, or you could. That's what I said. You could if you manage to get a process which will carry hydrogen at an economical cost into blast furnaces, then you have scale. But that's not close. It's some way to go before you perfect that technology, get the cost down, etc., etc. So, yeah, it'll take some time.
Thank you. The other, I think Matt alluded to it. The other thing that is a growing theme at the moment is how coal companies go forward in terms of asset exposures, and in particular, the BMC sell-off. Tom, from an equities perspective, very interested in your view on, okay, what kind of money might be attracted to look at something like BMC? Will we see another rush to IPO? Or do you think coal companies will now be saying, look, we're far better off being unlisted, away from the scrutiny of green activists? Where do we go from here?
Yeah, it's a dynamic position. Obviously, there's been trends in asset ownership over a long period of time, and certainly concur with Mark and Matt on the owners of long life assets are certainly in the best position to leverage the dynamics that are likely to unfold in markets themselves. So what we've been talking about, the involvement with China, the policy change there, the change in trade flows, the higher costs of capital increasing the barriers to entry, it only places more value on the owners of those existing long life assets. And so it's really fascinating at the moment. If you're talking to BMC, trying to enter that market perhaps, but you're also trying to consider the outlook for volume, where some of these assets have significant rehab liabilities, where should green steel accelerate and that rehab liability occurs far earlier in the asset life than you hope, than the asset life actually is, which in some cases is decades, then how do you negotiate with the seller around accounting for that risk? And so it requires capital with probably a far higher risk tolerance than traditionally. And given the idea that we've talked about, the pool of capital willing and capable to invest in this space is shrinking, it points to, for lack of a better word, more eclectic source of that capital. So less traditional owners, perhaps private equity. I've heard the term black funds mooted in the last little while. entrepreneurs, etc. So without knowing how that process is going, it's going to be fascinating to see how rehab liabilities, the risks of volume decline, depending on what your view is, are accounted for, how that plays out in pricing. Because in the equities market, in the listed space, there's a growing dislocation in what public owners of assets have versus the private owners of assets. And I think you're right in terms of, public markets are probably not suited to these types of companies going forward, given the likely transition in ownership to less traditional players and the obvious barriers to efficient investment in public markets at the moment.
Thank you. I'd like to ask Matt perhaps to respond. Matt, you are notoriously private and clearly you've had funding to take on the Millennium Mavis Downs asset. How would you describe the funding environment vis-a-vis what Tom's just outlined to us?
Yeah, thanks, Marian. And regarding BMC specifically, I'll remain private about that one and just make some generalizations. But I think Tom is right. It's a clear direction that sellers of these big assets are more and more having to take responsibilities for the liabilities that have occurred until now. And the transactions that we're seeing are reflecting a desire to effectively take those or account for those somehow on the seller's side for the people who want to move assets onto this group of new investors, if you like, who are prepared to come into the met coal space. There's still definitely a big pool of capital available for investing in met coal markets. I think there is some contagion from ESG pressures to both equity and debt that Tom referred to, and in some cases, there's an expectation of a greater coupon or a higher return for investing in the space. But there's private high net worth hedge funds. There's particular regions around the world who might be more locally tapped into the demand that's coming in particular areas. So I think there is a pool of funding available, although the participants in that are definitely changing.
Mark, can you offer any view from your perspective? You're private. You don't have to worry too much. Mm-hmm.
Well, look, we're blessed. We're very, very low debt, and we sit low on the cost curve currently, and selling coals, which at the moment have a global appetite. When I stop and listen to this, and I think about our future, our potential future, growth pipelines and things like that, I start to also think about, I guess, where our competitors or our peers are sitting as well. And you hear Matt and both Tom talk about potential change in the way, and I guess this goes to a concern from Rajiv, I guess. We all exist in a very, very heavy capital dense business, billions of dollars invested on both sides, whether it's in a large coal mine or steel mills. Blast furnaces are built 20, 30 years, that type of time frame. You start to move in this PE black funds. I haven't heard that before, Tom, but I'll note that one down. Moving in now into that space, and that changes that dynamic. 30, 40 years ago, Australian metallurgical coal mines, Australian coal mines full stop, are owned by large companies, which you were able to stable supply, were there for the long run. You start moving in different sources, it changes that sort of that view and the perspective of or the drive of those businesses, or the owners of that business, faster returns, so forth. So it actually changes the ability to supply and how they bring coal to market. I guess there's a concern that we have, and I guess is a point of differentiation, because we are private and independent and have a long history and potentially very long future ahead with our reserves there. It's an interesting landscape to be in. We're very happy to be private.
Rajiv, I think one of the themes that you articulated to me earlier was concern about the supply side. Given, I guess, the context here, where you're talking to people who are looking into their future, is this a looming concern for Tata in the near term?
Yeah, so as you know, logistics is a big part of the supply chain as far as bulk materials are concerned. India, so Australia is very well positioned to service the Far Eastern and the South Asian market. But we have concerns on the efficiency of and the cost of the supply chain, the reliability of the supply chain, the disruptions that we face. We've been trying to encourage companies as Tata Steel to manage the inventory more efficiently out of Indian ports, so that there is a continuity of business, there is a better visibility of because as you know, steel is a continuous process industry. You've got to afford to, and if you have stockouts and you have blend changes and the cost implications, and there's a lot of disruption that we have. So we've been working at it, and my CEO has also joined the this initiative in trying to get more visibility of how the supply chain should work in a more efficient manner. We've been petitioning the governments, the Queensland government, the Federal Resources Minister, etc. I think it's an important point. I think people should be mindful of that, because the alternatives will come if we don't pay attention to that. Australia's got some of the best coal in the world. You've got to deliver it efficiently. And if it doesn't get delivered efficiently, then you are going to look for alternatives which are maybe not as good in quality, but in terms of supply chain, easier to handle. So I think miners and have also been part of this discussion, and we've discussed this also with the CEOs of various port facilities and mining companies and railroads, and we need to. It's improved, but it's not where it should be.
You straddle Europe and India. Perhaps you could just make a few comments on the whole carbon border issue, the tax issue in Europe. Is that, obviously it's going to add a cost. How does Tata go forward with two such different jurisdictions? It's not very far from each other, right? Europe is highly visible. There's obviously it's much more advanced in terms of the movement towards carbon neutral environment and tax issues. But we're not far away from that in India as well. There's so the carbon emissions targets have been set, and they're not negotiable. And therefore, whatever we are doing in Europe, we are contemplating going the same way in India. So they're not very different, Marian. It's just that maybe in terms of the evolution, they may be a little bit in front or behind each other, but they are going to converge quite quickly, because it's a global issue. It's not simply an Indian issue or a European issue. It's our planet, right? So and there are global institutions, investing communities. All of them are in this space. We are part of the Responsible Steel initiative, and of course, and that's right through our supply chain, right down to our customers. We are accountable. So it's not going to be too very different in Europe as it is in India. Thank you, Tom. Where do we go next? What is your forecasts say about what happens next in the space?
Don't know if I'd be sitting here if I had the perfect answer to that question, Marian. I guess we've been talking about risks quite a bit here, but when you look at the balance of all this information, there's also quite a lot of opportunity. There's, in terms of the market story, in terms of constraints on supply growth and servicing that growth in demand, if you look at a realistic transition to green steel, then those long life asset owners should enjoy some. I do think that one of the byproducts of the dynamics we've been talking about is going to be greater volatility, and it was always a pretty volatile market anyway for logistics, seasonality, demand sort of reasons. Those risks probably go up, and that volatility probably amplifies from here. But if you think about, those risks also bring opportunities in terms of dislocations in opinions on value. There's going to be some, nameplate assets transacted, and eventually it's plausible to see BMA assets come to market in some form. If met coal has decades of a future and has price cycles above 300, you will see asset owners pay off transactions in a short period of time. So yes, there are risks, but there's also a lot of opportunity, and that is across the board for anyone who's interested, from those new styles of asset owners, be it private equity, family money, hedge funds, entrepreneurs. It could include customers. The equity markets, they are variable. They're out of fashion with this sector at the moment, but one of the things I do like about them is that they regularly present you with dislocations in value and easy opportunity to capitalize on that. So I'd love looking at the dynamics of this space because they're so variable. It's going to be a more uncertain space in terms of asset ownership and transition with all these unknowns behind us, but with risk does come opportunity.
Can an equities analyst make money by delisting a company, or is that does that not work?
By definition, that's difficult. But no, look, I think I agree with the guys that there is enough capital globally that has enough interest in this space to see it attract investment. I do think that capital needs to be more under the radar than it used to be for obvious reasons, but I do see an opportunity for that style of capital.
Oh, thank you. Mark, looking ahead for you, you've touched on some of the risks, but give us a bit more flavour for that.
In terms of market, Marian, or in terms of being a coal miner in the 21st century in Queensland?
Take your pick. ESG, license to operate. Rajiv's thing about supply chains, infrastructure. What's your top pick?
Well, I think some of the challenges in the business is, irrespective of whether you need to touch on equities markets, it's insurance. Insurance is an area, and I know it's been an area of recent observation by the Australian government in that space. But it touches all parts of your business. And while you might not need to be tapping capital, you certainly need to be continuing to insure your business, and the cold chain assets that ensure you can get your product to marketplace.
Can you self-insure, Mark?
Well, this is a question I think the industry needs to ask itself: is can you get together, club together, and start self-insuring? All of these sorts of things. It's a little bit out of my out of my pay grade at that, but it is an area which is very regularly spoken about within this business. I'm sure around all board tables, in terms of that cost of insurance, it continues to go up. The fundamentals there in metallurgical coal, as everyone has touched on, is certainly the next 20 to 30 years. It is firm. It's real. Concern is, of course, is that and Tom touches on that volatility. But as that trend continues, as the constraints on the supply side, whether it's through ESG or through permitting there, we continue to see prices just cycling up over time. We do get to that substitution point, which Rajiv talks about, where eventually solid carbon into the coke battery or into the blast furnace actually becomes too expensive. So we can actually price ourselves out. And our job as an industry is to ensure that we remain as low cost as possible, so we are always presenting the lowest cost alternative as essentially a carbon supplier into the steel industries globally.
Well, Matt, you're at the coalface, as it were, of a company, taking on insurance, positioning yourselves, finding capital, finding workers, all of that sort of stuff. Has it been an easy ride, or is the hair loss related to it?
Look, taking a glass full approach.
You're very scratchy, Matt. We're struggling to hear you.
Can you hear me there?
That's better. That's better, Matt.
When taking the glass half full approach, Marian, the positive thing about COVID is that it's been and the cost pressures in terms of the revenue that we're receiving here in Australia, it's been a timely reminder for people focused very heavily on cost. And even us who are looking at starting a coal mine this year, we've been constantly reworking and revising and scratching for that extra way to keep costs down. Where we sit now, I think we're in great shape. You look at the forecast this year for economic growth, you look at the forecasts for industrial production, you look at the forecasts for crude steel production out of the WSA, it all looks very healthy, and that's reflected obviously by those steel prices of $1,000 circa for hot rolled coil. I think that underpins a very strong opportunity in the short to medium term. There's going to be challenges, but I think being part of the industry is going to present a number of opportunities because of the difficulty to get into it, and probably a much smaller pool of people who are prepared to operate in the met coal mining industry. But one thing we do know is that in the future, there's going to be more mining than there is now, whether it's in a different commodity, cobalt or copper or whatever that might be. So there's going to be plenty of opportunities to come out of it. And for us, we're taking the ESG pressures very seriously, and we're looking at using the methane that we drain from our underground, for example, to make hydrogen to power our trucks. And you have to always look at the fact that as a mining industry, we have a captive market in which all of the ESG players are looking towards. I had lunch yesterday with the Minister of Energy and Hydrogen, together with the heads of most of the renewable companies here in Australia, and they're all very interested in what the mining industry is doing. So I think we need to be cognizant of those opportunities as we move forward, together with the opportunities that that met coal demand. As Mr. Mukerjee said, people are still building blast furnaces, which are very large-scale investments over a long period of depreciable time. And this period through for the next 10 years, in my view, can be a golden era. So I'm bullish, Marian.
I should hope so, Matt. Segueing briefly to PCI, Rajiv, you, from what I understand, procure roughly a third PCI. Hydrogen has been described as, it couldn't be used as an injection replacement for PCI. It's a coolant. A lot of people think that if you look across the spectrum of metallurgical coal types, things like PCI would be the first, thing at risk. Do you share the view, and are you concerned? Because other point to make around PCI is right now the price regime is not conducive to people bringing back idle capacity in Australia. So you've got a nexus there. We understand the market is structurally short right now. People are desperately trying to find it. The Russians are putting all their PCI into China, as you suggested. How do you see the PCI world?
Yeah, at the moment it's a bit difficult. Yes, so the short term it seems strange, because short term it is difficult to find the stuff, and as blast furnaces get larger, And as long as blast furnace technology is around, there will be a demand for PCI. But it will also be potentially the first casualty in a technology transformation, right? And therefore, whether it is oxygen enrichment or whether it is hydrogen, it is going to reduce the demand. It's a question of cost. And why are we in coal? Why are we using coal in steel and iron making? It's because it's the cheapest possible, reductant we have now. And its calorific value and per cost is not matched by any other, substance. So and therefore I say, be careful of technology disruptions. It's good to say, yes, we will have blast furnaces. It's good to say we'll have hot metal produced through this route for the next 30 years. But one modification of the process in a blast furnace can upset the whole game. So at the moment, to be honest with you, we haven't, the industry hasn't found an economical way to do it. But a lot of people are working on it, and as has been mentioned, and therefore I also think, just an added point, we've been buying coal. I've been in this game for a long time. We've been buying coal for 100 years for steel making, and the relationship between the suppliers and the steel makers, it has been one of buyers and sellers. It has to be more collaborative. You need to get involved in the technology of steel making as a miner, and steel makers must understand mining better. We are also a 35 million ton mining company, right? So we understand that subject a little bit more. But if we're not collaborative, in the sense we find solutions together, then it's not going to sort of end in a positive way. It's going to remain this situation where we are always looking for solutions, and the mining industry is not part of that solution, right? That we need to fix.
Thanks, Rajiv. Mark, as a major PCI producer, I'll give you 45 seconds to respond.
7 million tons per annum of PCI. Obviously we have our eyes on this situation. I keep coming, and Rajiv touched on it, I keep coming back to ensuring that you do not price yourself actually out of that technology. Ensure you're still always the lowest cost until such time as either through other regulatory issues and so forth, you're forced out. The idea is to remain the cheapest solid fuel that you can inject into a blast furnace. Simple as that. But we're big eyes, obviously, in that space, and Rajiv is right. That disruptor is potentially there. I'm not even thought of at the moment.
Thank you, Mark. Matt, we're almost on time. Last moment reflections from yourself.
No, I think it's been a pleasure here to be amongst these fellow panel members, and I think it's a very interesting market, but an exciting market. It's really good when the total value chain is earning healthy returns and healthy margins, and I think the demand is strong, and there's going to be opportunities right through the value chain in the industry for quite a few years to come yet. So that's kind of my final comments, Marian.
Thank you, Matt. Tom, 30-second pearl of wisdom, please.
I'd probably just concur what I said earlier, Marian. It is a fascinating market and always has been in my short time looking at it, and I dare say will be for quite a long period. It is described as a sunset industry, but there's plausible reasons why it could be quite a long summer sunset in terms of returns that Matt just alluded to. So the dynamics and the people will change, but it will always provide opportunities.
Great. Thank you all so much for your excellent insights. I really enjoyed talking with you. And with that, we will wrap this up. Thank you, everybody.